Good day. My name is Emmanuel Mangeria, Senior Associate Analyst with the Bloomberg Intelligence Metals and Mining team based in London. Today, I'll be taking you through our gold mid-year outlook for the second half of 2022 and into 2023. To begin, let us look at the macro picture. Gold, on all accounts, looks overvalued to us. And if we compare it to our regression models, with gold at spot of about $18-20 an ounce, investors are paying a hefty premium of between $300 to $400 an ounce for insurance against runaway inflation and an escalation in the war in Ukraine. Now, although gold has traded well above the implied fair value historically, as can be seen on the chart, and specifically between late 2010 to early 2012, peaks topping $300 have been far shorter. If we were to take a look at gold from a relative value perspective, the metal is 25% more costly versus its long-run inflation-adjusted averages. In addition, the decline in copper and global equity markets as global growth concerns intensify also make gold appear less attractive. Our analysis shows that gold only looks cheap versus two metrics. Firstly, bloated central bank balance sheets, and then secondly, oil, as supply constraints squeeze the oil market. In summary, at current spot prices, gold's relative value is trading at about $210 an ounce, above the average implied price of the 8 constituent metrics in our relative value framework, versus $160 an ounce at the start of 2022. Looking further forward, although we agree that gold's premium versus fair value may remain, price forecasts may be too optimistic, with consensus expectations averaging about $1,900 an ounce in 2022, up from $1,725 in November 2021 and $1,850 in 2023 versus the November 2022 forecast of $1,650. We believe price rallies over $1,900 an ounce may be short-lived, while support at $1,750 could limit downside. It is worth a mention that while gold producers have been gun-shy towards hedging over the past decade, current conditions may prompt some to look at locking in attractive forward prices. So, what does that mean for gold equities? Despite our view that gold may edge lower, the gold miners may prove to be defensive in an inflationary environment, certainly versus other mining sector peers. While the miners' margins could be squeezed by 3 to 5%, as labor and energy costs rises erode any volume benefits, they may still fare better than the platinum group metal miners, where the earnings momentum is likely to remain negative as the basket prices continue to fall. As a single operating company, Centamin's cost may increase the most, as it's the most exposed to grade declines. While the ramp-up of AngloGold's Obuasi mine and good operational performances from Goldfields and Yamana could keep the margin declines down to 3 to 4%. Consensus forecasts factor in very little margin erosion versus 2021, according to our analysis, and may be underestimating inflationary pressures and not taking gold's recent weakness into account. On a spot gold price scenario of about $18-20 an ounce, Barrick could deliver the sector-leading EBITDA margin of just shy of 53%. While the rest of the senior large-cap producers delivering margins of between 38 to 52%, with Goldfields ranking slightly behind Barrick. In this scenario, AngloGold could well be the sector laggard. Given Goldfields' financial and operational leverage, as well as the unwinding of unprofitable hedges, the company could achieve a sector-leading return on capital employed of more than 23% in 2022. Whereas Newmont could be the straggler on returns, with the Goldcorp acquisition bumping up capital employed. Taking a look at valuations, which appears to be reflecting a cautious outlook to bullion prices, with the sector EV to EBITDA of 5 times. That is below the 10-year average of 5.8 times. The top 6 senior gold producers fall into 2 distinct tiers, with reserve life, concentration, and M&A the key determinants of the multiple where gold equity may trade. Those with 10 years and smaller assets attract the lower multiple, while a reserve life greater than 15 years with fewer large assets draws a higher figure. Now, in our view, the divergence may be too extreme. Barrick's new dividend policy means it now ranks closely to Newmont on most metrics, yet the company trades at a significant discount. Whereas AngloGold's discounts to peers may close should the company restore operational performance. In closing, despite the possible price volatility, following Goldfields' bid for Yamana, conditions are ripe for gold sector M&A to accelerate, with strong cash flows looking for a home after 2020 to 2021's rapid balance sheet deleveraging. Many producers face declining output as reserves shrink, or are simply looking for growth options, while the need to be noticed by generalist investors may continue to drive mergers. Thank you.